Thank you, Nancy. So, welcome everybody. I'm just looking down the attendees list. So, I think I know a few names on here. So, apologies if you already know some of this information, but hopefully, if you do, it's a refresher for you guys and anyone that is sort of not spoken to me yet or goodwill um, at all in terms of finances. Hopefully, this is a good sort of overview of what you'll need to do on an annual basis for your limited company. So, I'm the head of finance here. Look after the team that deliver our finance services to clients. And I'm joined with Becky, who is our senior financial controller and pretty much heads up our annual accounts team and delivers sort of the year-end compliance work for our clients.
Yeah, morning everyone. I'll probably give a little bit of an intro, I guess, when I start my part a little bit later on.
Becky. So for those who aren't aware about Goodwill, I'll just give a brief introduction of who we are and what we do. So we've been established over 25 years now, and we help basically overseas companies set up here in the UK. We offer a full sort of outsourced back office service. So it covers 5 departments. So I'll briefly touch on those now. So governance is one of our departments. They look after the company secretarial duties of your UK establishment. Anything from setting up here in the UK to ongoing annual compliance, any director's responsibilities, board minutes, and the requirements around sort of your UK entity. We have a HR department as well. Look after the life cycle of your employees if you want to hire here. So that can start with benchmarking employees all the way through to the hiring process and making sure you're compliant with UK employment law. We have a payroll team, so closely connected to our HR team. Of course, if you're going to hire people, you're going to need to administer a payroll scheme here in the UK. And that's what our payroll team do for you guys. Our fourth department is a virtual office or front of house service. So predominantly a telephone answering service, but it can also be a operating address, and quite a bespoke team. So if you want to come to the UK and hire a meeting room, for example, we can offer that service to you. And then last but not least is our finance team. So that's the department that Becky and I work for. So we pretty much offer everything to do with day-to-day bookkeeping, banking, all the way through to monthly accounts, and then the compliance side of things like VAT, annual accounts, which is sort of the focus of this webinar. So I'll pass to Becky. And actually, sorry, no, I won't. I'll talk a little bit about the agenda before we pass to Becky. So I'll cover this very quick because I don't want to steal any of Becky's thunder. But basically, we're talking about what are annual accounts. So I think it's a common theme in every country. So hopefully you're aware of that. But how the UK is specific, and what sort of rules and deadlines apply here. Anything important to consider, and then basically some regulatory change on the horizon. They probably won't be coming into about 2027, I don't think, but I'll still touch on those. And then we'll just finish off. I'll talk a little bit about VAT and what you should consider around UK VAT.
Cool, I'll take it from here. Thanks for the intro earlier, Dom, and morning everyone joining today. Hopefully by the end of it, you do come away maybe knowing just a fraction more than you did before. So yeah, fingers crossed it is somewhat useful. A bit of an intro from myself. As Dom mentioned, I work alongside him here at Goodwill as part of our wider finance team. I personally am quite heavily involved in the year-end procedures for a multitude of our clients. So annual accounts, corporation tax, and all that goes along with it. So thought it'd be quite useful for me to join this webinar today and give you guys a bit of a rundown, I guess, of what they are, timelines and your deadlines to adhere to, and just some, I guess, key considerations, common queries that we see crop up to help ensure your complete compliance throughout. So just starting with what they are. So your annual accounts, otherwise known as your statutory accounts, they make up the financial statements that your company must prepare at the end of each and every financial year. Their aim is being to provide a summary of its, I guess, financial performance and also its position at the end of the year. Now, quite how much information is disclosed in your set of accounts, that is largely dictated by the size of your company. So put quite simply, I guess, the smaller your company, the less information. The larger your company, the more information, the more policies, the more disclosures, the more notes to the accounts, things like a cash flow statement, things you otherwise wouldn't find in a smaller company set of accounts. So you will hear kind of various terms thrown about, FRS 105, 102 and 102.1a. They are all the various kinds of reporting framework under UK GAAP, which, as I say, is driven by the size of your company. I imagine for the vast majority of you guys today, I suspect you'll probably find yourselves somewhere in between the two extremes of a micro entity and a large company, and you'll be preparing your accounts under the reporting framework known as FRS 1021A. So that's the small company regime. Essentially, what that means to you is that you can make use of certain exemptions and reduced disclosures, at least in the set that you submit to Companies House, the set that is publicly available. So I think things like your director's report, your auditor's report, if one's needed, and your detailed profit and loss, all of that can be restricted and taken out of the set that you submit to Companies House. Now, that's the one that obviously is available on the public record. So people do, if they can, make use of those exemptions and really restrict what's just there available at the touch of a button to anyone that wishes to look. So to be eligible to prepare your accounts under FRS 1021A, there is certain criteria that must be met. So your company, you must have an annual turnover of less than 10.2 million. You must have total assets of less than 5.1 million and an average number of employees for that year in question of less than 50. So as long as your company is meeting at least two of the three of that criteria laid out and do so for 2 consecutive years, then you can apply the small company regime and the applicable framework that goes with it. Obviously, if you're a brand new company in year one, you take that year in isolation. So whichever threshold you're below or exceeding, you apply the applicable framework. But let's say in year two, after being a startup in year one, you're small, but suddenly year two, you see a massive spike in turnover, your staff numbers and whatnot, and you've suddenly exceeded those small company thresholds. You would not at that point be duty bound to suddenly start preparing full accounts. Only in the second year, 2 consecutive years of exceeding, would you then need to switch up and start preparing full accounts. And same the other way. So if you're a large company early on, but suddenly your activity drops in the UK and you start to see staff numbers drop off and turnover reduce, you can't suddenly start making use of those reduced exemptions and disclosures. You have to be below for 2 years before you can switch up that framework. So yeah, that's a little bit about, I guess, these accounts that go to Companies House. As I say, they are the ones that are known as filleted accounts, your reduced accounts that are available to the public. But by contrast, the accounts that you submit to HMRC, so you'll submit your accounts to Companies House in a reduced format. You'll then have a tax return that needs to go to HMRC. Now, accompanying that tax return, you must actually prepare and submit a full set of accounts. So that will include the previous mentioned items like your director's report, all the notes and accounting policies, and more importantly, your profit and loss account. The reason being, obviously, if HMRC are getting that tax return, they're going to want as much information to go alongside that to help properly ascertain, I guess, whether the profits they're seeing as chargeable to tax are in keeping with what the accounts are telling them, just to help target their inspections, avoid tax fraud, and I guess just make sure that companies are generally not mispresenting their financial health. So yeah, reduced accounts, Companies House, full accounts, always HMRC. Now, I cannot stress the importance of obviously submitting these on time. Failure to do so not only poses, I guess, a financial risk in the penalties and interest that can really quickly begin to mount up. And that's from both HMRC and Companies House alike. So, 2 separate lots of penalties and interest on both sides. But that aside, the directors themselves could face potential legal action. Obviously, submitting your accounts on time is one of the basic requirements of a UK director. So failure to do so does put them at huge risk there. And it also puts the company itself at risk of being struck off from the register entirely. So yeah, really important to stay on top of these, make sure they are being submitted accurately and on time. I think in a moment we will look at a standard timeline of a UK company. But before we do, I think briefly just at the bottom of this slide, you'll see we've just popped a little bit of an overview as to a UK audit and what that is. I think a bit further on as well, Don will touch on the thresholds for that and other things to consider. But just, wanted to highlight a UK audit completely independent to your group audit and is external, not, internal audits can be done as frequently as you want. This is an external audit firm that would be conducting this to ensure that your accounts are free from any misstatements. So although it is independent, the preparation of the accounts and tax themselves, they sort of go hand in hand with one another. They're done in conjunction at the same time to ensure the set that is eventually submitted is accurate. So Goodwill are not obviously a regulated audit firm, but obviously with the client base we've amassed over the years, a large proportion of those being UK subs of larger overseas groups, typically requiring a UK audit. We have built up obviously quite strong relationships and partnerships with some of the UK firms that we do work quite closely and in cohesion with. So yeah, if you're in any doubt, we can obviously go to market, get quotes, and point you in the right direction really of where to start. So please do just ask. Nancy, if you wouldn't mind then moving on to the next one. Thank you. So what we've got here is just a really simple timeline of a company's annual accounts deadlines and things to consider. So we've used in this example a 31st of December year end, which I think does tend to be pretty commonplace, we find, for probably over 90% of our clients, usually aligning their year end with the reporting period of their parent company and their other group entities for ease of consolidation. In an ideal scenario, just starting from the very beginning, your appointed firm, Goodwill, hopefully will have been staying on top of the bookkeeping and accounting on a monthly basis, or perhaps quarterly, I guess, depending on the level of activity. So really when that year end rolls about on the 31st of December, then maybe bar a couple of adjustments for things like a tax provision, a holiday accrual and whatnot, you should be ready to go. So from your year end on the 31st of December, you have exactly 9 months to submit your accounts to Companies House. So in this scenario we've got there, you'll see the deadline being 30th of September 2025. So we have many sets of accounts already underway. Getting ahead and starting as soon as possible, really key there, as it does very soon creep up on you. Now you'll see on that same timeline, the deadline, however, to file your tax return with HMRC is not until December, so a full 12 months after your year end. However, a big caveat to that, as also noted on there, is that the corporation tax payment deadline is actually 9 months and 1 day after your year end. So pretty much the same as your filing deadline with Companies House, bar 1 day. Logically, to me, it makes no sense that you would be paying your tax bill, at least not accurately, before the return has been prepared and submitted. So we tend to see it all as, I guess, one full deadline of the 30th of September to have the job lot done. So your accounts submitted to Companies House, tax return and accounts to HMRC, and your corporation tax all paid up. So yeah, that's a pretty standard timeline. I think there are obviously some exceptions when you change your year end, which Nancy, if you wouldn't mind going to the next tab, I think it's one of our first points there. Yeah, oh, perfect. So yeah, top one on the left, if we start there, your accounting reference date, your otherwise abbreviated to ARD. When you incorporate a company in the UK, your accounting reference date, your year ends will preset to effectively the end of the month, 12 months on from now. So if I set up my company today, I'm going to have a year end with Companies House that says my first set of accounts will need to be made up to the 28th of February. What would that be? 2026. Now I can change my year end. However, a set of accounts cannot cover more than 18 months in total. So instead of being able to extend from February next year to December of that same year, I would have to instead shorten my year end to December 2025. So you can shorten your year end, I think we've noted there, as many times as you want, but you can only have the option to extend once in 5 years. So yeah, really key to bear that in mind. When you start changing your year end as well, this is where people can quite easily get caught out. You also do need to consider the impact this has on your filing deadlines. So I don't think such a concern when you're shortening your year end, because you'll still get 9 months from what will be your new date. However, if you're extending it, this won't change. So you'll effectively still have 9 months from the original 12-month period end, if that makes sense. So if you have a company that's incorporated in July 25, and rather than shortening the year end to December that year, you decide, okay, let's defer and extend it all the way to December 2026, you will find yourself with actually a mere 3 months post year end to get those filed by the end of, God, what would that be? March 2027. So yeah, just something that really catches people out. You are notified, I think, when you submit the year-end change of what your new filing deadline will be, but it's very easy for people to just sort of forget about that at the time, and suddenly December passes and they think, God, I've got 3 months to get everything done. I've not done my bookkeeping. Can someone help me? And that's usually probably where we step in. So yeah, something to be mindful of if you're an early incorporation in the year and you've extended, then yeah, obviously keep an eye on that. And again, if any doubt, just give us a shout. And I think before I pass on to John, just a couple of things here on rates and disallowable costs. So, God, I think it was almost 2 years ago now, the changes to corporation tax rates, April 23, I think it was. So we now have two different rates of corporation tax. So for companies with profits of 50,000 or less, you'll pay at 19%. For companies with profits of 250,000 or over, you'll pay at 25%. And for companies sort of somewhere in between, a marginal rate applies 26.5. So effectively what that means is you'll gradually start tapering up from 50 to 250 until you hit that 25% overall. Now, the really key thing to bear in mind, I've not put it on the slide, but something to mention still, is that these thresholds need to take into account the associated companies of your UK limited company. So when we're preparing the accounts, you will find I'm asking for a copy of your latest group structure each and every year. The reason being those thresholds need dividing by any of your associate companies. So using a really simple example, if you're a UK sub and you've just got your parent overseas, you've got one associated company, suddenly that 50 grand becomes 25 and that 250 threshold becomes 125. So obviously big groups, it can have a massive knock-on effect. So yeah, really key to keep us in the loop as to your latest group structure and any new entities falling under that same, I guess, group. So yeah, I think any other thing before I do let you get a word in edgeways, Dom, is just on the disallowable costs. So generally speaking, your corporation tax return, I mean, you guys on the call probably know the real basics, but turnover, less cost, you're going to have your profit. That's generally what you expect to pay your corporation tax on. Now, in arriving though to your taxable profits versus your accounting profits, there are a number of costs that need considering and sort of added back is the term. So things, big one is your customer entertaining. So if you're taking out a client, a new prospect for a lunch, and you're footing the bill for that, you can have 50 grand's worth of business entertaining that year. Your tax bill is not going to change by a penny because of it. That's added back on for the purpose of your taxable profit calculation. Same goes for penalties and fines. Interest is deductible, penalties are not. Depreciation, obviously not an actual cash expense, that's added back on, and other non-business expenses like clothes. There are other things that crop up, things to do with certain legal fees. Again, there's lots and lots of different scenarios. So if you are in any doubt, of course, just ask the question. Always better to ask than, I guess, be stumped when you do get your tax bill and it's not what you thought it might be. Yeah, I think, should I let you probably tackle the last couple of points on this slide, Dom?
Yeah, absolutely. Thanks, Becky. So audit requirements. So does your UK subsidiary require an audit? Is a question we get asked a lot of times. Becky mentioned the criteria of a small company earlier in the slides, and it's the same criteria to assess audit requirements. So they're on the slide in front of you there. There's three criteria. When you're a subsidiary, you require an audit by default in the UK, and there's three ways to get an exemption from that audit, and they're also on there. So the first one is if the entity is dormant. Again, that's not the case for a lot of our clients because they set up an entity here for a purpose, obviously to trade. The second is if they have a UK parent. And again, that's for our clients. That's typically not the case. They're typically owned by their parent based in the Nordics or elsewhere in the world. And the third way, which is where we can have the conversation, is if the group is not large. So they do look at the group set of accounts, so the parent company and all of that subsidiaries consolidated together to assess whether that UK subsidiary requires an audit. And it is on those thresholds there. So if you are a large group overseas and have large sort of global presence, the likelihood is you will need a UK audit for that UK subsidiary. But like Becky also mentioned, we do have many partners in the network. So that's not particularly an issue. There's an additional cost in there, of course, but it's usually quite painless because the entity in the UK is quite small in itself. So it's quite a fast audit, we find in our experience. Dormant entities, again, final point on this slide. Even if you are dormant, if you set something up and maybe things pause in the UK or for whatever reason, things are on hold, there is still these annual requirements. So the need to do a corporation tax potentially goes away. Tax return, that is, so we can talk to HMRC and sort of and pause that requirement for you. But Companies House still will want annual accounts, and that's covered, of course, by our services. We'll look after that dormant account for you just in the same way we would with the trading entity. So we go to the next slide, please, Nancy. Thank you. So some regulatory changes. So we'll touch on this very briefly. Basically, the UK government are passing a bill at the moment. Some of it's already gone through. Some of it is to go live still, but it's called the Economic Crime and Corporate Transparency Act. So a bit of a mouthful. What this is basically aimed to do is they've realised that the way accounts are submitted and information is held, it doesn't help the authorities when it comes to tracing fraud and sort of looking into entities that are in the UK. So they just want to make things a bit more transparent, a bit more visible. Some of those changes and some are still to be confirmed, but is having an email address at Companies House. So that one's already gone live. If you're a client of ours and we are company secretary, then we've used our email address. So we've sort of taken that admin burden away from you. Some changes that will be going live soon are having individual KYC for directors and shareholders. Again, good news is HMRC and Companies House are going to rely on service providers that are reputable. So we'll have the chance to apply to them, and there'll be no issues with Goodwill being a reputable business in that regard. And they'll rely on our KYC and anti-money laundering procedures. So again, if you are a client of ours, that shouldn't impact you because we should have an exemption from that. But if you don't have a provider in the UK, for example, and you do everything yourself, then you would have some additional compliance needs there with Companies House. And then finally, this is quite an interesting one. This is the one that's being held up at the minute and likely to go live in 2027. So still a little while away. But there's going to be increased disclosures for small companies. So as Becky mentioned earlier, as it currently stands, you can have heavily reduced disclosures when you submit your publicly available accounts at Companies House. So for example, you don't include a profit and loss account. That is set to change. And it's sort of more aligned across all companies, no matter what your size. So you'll have to start disclosing more director information and P&L, profit and loss account information. So we're watching the space on that quite closely. It's going through Parliament at the moment, and we'll see what happens there. But of course, we'll keep everyone informed as and when things change. Perfect. Next slide, please, Nancy. And then finally, from me, some VAT compliance. So I won't go through everything on this page. I think everyone will be familiar with VAT anyway, across particularly Europe, but how the UK looks different. So I think a key point is having taxable turnover. So to have VAT, you must have some kind of turnover in the UK that's subject to VAT. For example, we have a number of clients that are in the medical space or potentially in the educational space where they're exempt. And if that's the case and you don't have, and all your turnover relates to exempt VAT sort of category, then you're not able to register. But of course, we can look after that and have a conversation with you when you first set up your business here. Other key things to think about are, I'm just looking down the slides now, particularly the last point actually I'll just touch on is around international aspects. So it all centers around the place of supply. So you can either supply goods or supply services to your customers. If you're supplying services, then there's a general rule, and it depends if you're supplying B2C or B2B. Typically, our clients are B2B, so it's where the supplier is based. So that can, if you're just operating from your overseas company without a UK establishment, and you can sort of avoid those requirements, then you might be able to avoid UK VAT registration as well in that scenario. Where if you're selling to B2C, it's where the customer is based, and that would be the UK, and therefore you'd be captured by the rules. And then goods is really dependent on your Incoterms and commercial agreements. So if you are selling goods in the UK, it can be more complex here. So I'd say get in touch with us. And we also have a partner, which is a custom specialist that we typically get involved with, our sort of more complex clients that are selling goods. But really, it depends where your Incoterms dictate who the owner of the goods are when they cross the UK border. If the owner is yourself as a client that's selling to a UK customer, then typically you would have to register for UK VAT. If the owner of the goods is the end customer when they move over the UK border, then typically you don't have to register for UK VAT. The latter of those often isn't the case commercially because your customer would have all the requirements to deal with the sort of import duties and VAT payable. Typically, they don't want that. So typically, it's you guys that, as the clients, selling the goods that take on that burden, which does mean often that you do have a UK VAT requirement. And if you are selling from your overseas business, so whether it be your Swedish AB company or any other country, and you don't have a UK limited or UK branch, there is no threshold to register. So you'll see in this slide here, there's a 90k limit. So you can trade basically up to that 90k before you have to register for that. But if you're a non-established taxable entity in the UK, so basically you're an overseas company selling, that threshold is zero. So even if you sell, 99p worth of goods in the UK, you'll have to register for that for that amount. So that threshold is zero. Perfect. I think that's the end of the slides, right, Nancy? So what I would say is we'll open up 20 questions. There's a chat function at the bottom, but there's a lot of information there. Typically, we cover all this on onboarding, or if you're already a client of ours, I recognize, like I said, a few names on the attendee list, and this has triggered any thoughts or questions from you guys. Do get in touch with myself or Becky, and we can, talk you through those.
Thanks, Dom. It doesn't look like we've had